Hi everyone, and welcome to Cidel's annual investment seminar. My name's Henry Perrin, and I'm the president of Cidel. As you can see, I've taken off my sweatpants today and put on a suit to welcome you back to the Cidel offices. Now, unfortunately this year, you can't join us in the office, but I want you to know that we're still here. We're taking the necessary precautions to keep all of our staff safe and keeping focused on delivering on our promises to you. Part of that promise is thinking about the future. It's understanding emerging risks as well as preparing for sensible opportunities. And a year like this year has taught us that it's vitally important to focus on both. So today you're going to hear two presentations on emerging topics. The first comes from enjoying a couple Beyond Meat burgers over the last couple years. We're going to go deep on precision biology and understand its potential to disrupt traditional industries like the cattle industry. The second topic explores how companies are moving from the traditional concept of shareholder value to the broader concept of stakeholder value. We'll finish our hour with an investment panel discussion on investing in the aftermath of the US election, as well as investing in a post-pandemic world. So once again, thanks for joining us today. We hope you enjoy the seminar, and we look forward to seeing all of you, hopefully in person, in the not too distant future.
Five years ago today, it would have been very hard for anyone to imagine what we are going through now. Almost no one would have expected countries around the world would be in complete lockdown, working from home, sending their children to virtual high school, and having to wear a mask everywhere they went. And while the media keeps talking about a return to normal, most people are starting to realize change is the new normal. Offices have sent employees home permanently. Some small businesses have closed their doors for good, and only 7 months in, we're still learning about new ways the virus is impacting the way we live. Given how much COVID has disrupted our lives, I'm sure we're all getting a little worn down by the talks. So I want to first come out and say this presentation is not COVID related. My point for bringing it up is to reinforce the notion that things change, whether we like it or not. That change can be a slow grind over 10, 15 years, or something like COVID that shocks the world in a matter of months. Our jobs as stewards of client capital is to try and foresee as many of these changes as we possibly can and use that information while we invest your money. You'll never have it perfect, but by spending the time to understand the technology will at very least give us a leg up over the competition. In today's presentation, we're going to focus on the potential change in the cattle and dairy industry. We're going to look at why this is relevant now, how wide a potential disruption could spread, and speak to who we believe the key stakeholders are in the process.
So this is a chart taken from an A.T. Kearney study showing meat demand from 2025 to 2040. Picking up on Ryan's point about drastic shifts, unexpected changes, in this chart, perhaps not surprising is the growth in demand of 3% a year. But what is shocking, at least when I saw this chart for the first time, was the change in market share. So if you look at the pink band in the chart, that's the market share for conventional meat. And as you can see in 2025, it's estimated to be 90%. But then just 15 years later, it drops by almost half to 40%. That is very remarkable. And the question I found myself asking is, how is that possible? And that's the question that we're going to answer in this talk.
The one thing that we all have in common is that we all eat. From the beginning of time to the end of 2019, the population has grown to such that we now have 7.7 billion mouths to feed. But really, much of that population growth has occurred in the last 60 years, increasing roughly 150%. In the next 30 years, we're projected to add an additional 2.3 billion people. Add this to the fact that people in emerging economies are eating more and more protein, and we have a growing middle class. It's only natural to ask, how are we going to feed all of them? Consider this. We know we have more mouths to feed, but think about the landmass. In the US today, about 40% of the total US landmass is used to feed livestock. That's 835 million acres. 75% of which is used for the cattle and dairy industries. Each year, 20 million acres of land is cleared in the world for grazing livestock and growing crops. That is larger than the entire province of New Brunswick. Soon, there won't be any more land to clear. These two trends are showing no signs of slowing down, but aren't new problems. In the last 60 years, we've dealt with these two problems by turning to factory farming. We were able to maximize land, feed, and antibiotic distribution to produce the most meat per square acreage of farm. On top of this, we've become incredibly efficient at using animal byproducts. For example, it's common now to use the organs, bones, and hooves to make medicines, cosmetics, and nutritional supplements. But unfortunately, we've come so far along with this technique that any real improvements from here are on the margin. If we truly are going to add 2.3 billion people to the planet, and demand in emerging economies is going to continue to rise, we need to find an alternative to keep up with the demand. Of course, as the smart humans we are, we turn to science to try and help us solve the problem.
So you can see in the chart, the first track on top in green is called Novel Vegan Meat Replacement. Just think of this as veggie burgers. This is pretty self-explanatory. You take plants, you process them, you put the ingredients together, and you end up with something that has texture and taste like real meat. The only thing I'd add is that veggie burgers have come a long way. It's not all harvesting plants and processing them. For instance, one of the processes used in today's veggie burgers is something called precision fermentation. Very broadly, precision fermentation is a method that basically takes a naturally occurring production process and modifies it to yield something that we want. A prominent example is Beyond Meat uses this process to create heme. Among other things, heme is a molecule that gives meat its meat-like flavor. In terms of the second process, that's the bottom track in orange, cultured meat. So the cultured meat process starts by taking stem cells from an animal. You put the stem cells in a bioreactor with cell culture media. The cells then propagate. The next step is to differentiate the cells into muscle, fat, connective tissue, basically all the things that you would find in meat. The last step in the process is to apply these cells to a scaffold to give the finished product its structure. A couple points to make here. The vast majority of ingredients in this process is the cell culture media. Stem cells form a very, very small part of the finished product. And the important part here is that that cell culture media can be sourced from either animals or plants. Why is that important? Well, if you look at both processes, they are either 100% sourced from plants or they could potentially be. Now I'm going to talk specifically to sustainability figures in a minute. But first, to give you a sense, one way to look at this is to look at the calorie yield of a foodstuff. So if you look at beef, let's say, if you look at how many calories you put into the process and how many you get out, that's the calorie yield. And for conventional meat, it's around 15%. For these two processes, it's more like 70 to 75%. So you can see from a calorie yield perspective, these two alternatives are much more efficient. So in this diagram, you can see a broad comparison between the traditional approach in orange on the left and the new processes on the right in blue. And this specific example is looking at beef production. For the new processes, the most expensive things are the more complicated advanced products such as steak. A couple other points to make. One is infrastructure differences. So for traditional beef, if you think about all the things you need for that process, you need a farm where the animals are kept. You need a farm for the feed for the animals. You need a slaughterhouse. You need a processing plant. And you need transportation infrastructure to move all those things around. The new process, you need a bioreactor and a farm to grow the ingredients that go into the bioreactor. You also need transportation, but not nearly as much as the conventional meat industry. The last big difference is precision. So if you think about it, if you want a pound of ground meat, if you think about the traditional system, as I mentioned already, you start with a cow and you process it into more and more refined products. At the end of that process, you have your pound of ground meat, but you also have a whole bunch of other things. Now that shouldn't be seen as a negative against the traditional system, it's just a difference. As Ryan touched on, almost all of those byproducts go into other processes and industries. But by comparison, the new process, if you want a pound of ground beef, you put in the ingredients into the bioreactor, and when it's all done, you have exactly a pound of ground beef, no byproducts. Okay, so this chart speaks specifically to sustainability facts. And you can see the top row references animal-based. That's the traditional or conventional meat process. The bottom, that's referred to as lab-grown in the chart, refers to the new processes. And as you can see when you look at the first three factors, water use, greenhouse gas emissions, land use, the new processes are significantly more efficient than the conventional or animal-based approaches. One thing that obviously jumps off the page is the production cost. So you can see that the new processes are a fair bit more expensive in terms of production cost, but there are a couple points to make here. The first one, not shown in this chart, is the higher use of energy. So it turns out that these new processes use the same, if not more, energy than the conventional meat processes. The second point to make is that these new processes are just that. They're new. What I mean by that is that the new processes haven't had decades, if not centuries, to evolve the way conventional meat has. So given the differences in resource intensity, it's not a matter of if the production costs drop, it's a matter of when.
There are a few major hurdles to make alt meat successful, but we think cost will have the most dramatic impact on the speed of adoption. Here you're looking at the blue line, which is traditional cow beef. On the orange line, you're looking at precision fermented meat, which is what Ben mentioned, your Beyond Meat burger or your Impossible burger, the veggie burger with the addition of heme iron. On the right-hand side, you've got the dark blue line, which is cell-based beef. You can see here that RethinkX believes that by 2021, precision fermented beef is going to be cheaper than traditional cow beef. By 2025, 2026, cell-based beef is going to come down in cost where it's cheaper than traditional cow beef. This has major implications if you think about the fast food industry. The major tailwind we see with costs coming down is the availability for companies to use this in their off-the-shelf products or as a filler in their mixed products. Think about chicken nuggets or any frozen appetizer. If companies can use these alternative meats to achieve the same or better taste profile for an increasingly cheaper and more localized supply, you could see a massive uptake in this industry.
And the point here is that things can change very rapidly and not all sub-industries might be able to adapt. And what you could end up with are orphaned industries. Again, as Ryan touched on, there are all kinds of sub-industries under the conventional meat business, and some of these, as I say, could become orphaned industries or go out of business.
While we won't debate the timeline or viability of some of these products, we have to assume a significant disruption in the cattle industry, and in doing so, we have to try and understand the impact on various secondary economies. For example, pet food. It's a $24 billion industry that uses animal byproducts not considered fit for human consumption. There are 160 million pets in the United States alone, and the amount of meat they consume makes them the 5th largest consumer of meat in the world. What happens when they are no longer able to use cow byproducts? Similar parallels can be drawn to the healthcare industry. 80% of global antibiotic use is on animals. Materials and crops. Over 75% of global soybean crops are used to feed livestock. The key message here is that this disruption could be extremely wide-ranging.
The question at the start of this presentation was, how is it possible that conventional meat loses over half of its market share against a backdrop of rising demand? Well, after this talk, you really need to turn that question on its head and ask, how is it possible that given the difference in resource intensity of conventional meat versus these two other processes, how is it possible for them to maintain close to 100% market share in the face of growing demand? It seems almost inevitable that these two other processes, cultured meat and novel vegan meat replacement, will continue to take market share. As I also emphasized, cost is really going to be key in driving this. When we have rapid cost changes and businesses are involved, change can happen in a very drastic fashion, much faster than we might have assumed. So the point I emphasized in the presentation is that it's not a matter of if, but when prices will drop. And if that happens very quickly, businesses could drive transformation faster than we may have assumed. And with that, we have to be careful of all the sub-industries underlying the conventional meat business.
So as you can see, the disruption could be incredibly wide-ranging. And our job as stewards of your capital is to try and foresee as many of these changes as we possibly can. and use that information when we invest your money. You'll never have perfect clarity, but by spending the time to understand the technology, we'll at very least have a leg up over the competition.
The catalysts for change have been building for years, beginning with the financial crisis and more recently the climate protests, which almost seem a distant memory, and the powerful Black Lives Matter social movement. We believe catalysts for change within the social system as well as the capitalist system have been building for years. Our shareholder to stakeholder presentation looks at two competing evolutions of theories. On the one hand, you have shareholder value theory. On the other hand, you have stakeholder value theory. The shareholder value theory as it stands today was largely proposed by Milton Friedman back in 1970 in a New York Times piece. He says a business's only social responsibility is to maximize shareholders' wealth. The stakeholder theory on the other side proposes balancing the interest of financial shareholders against other stakeholders like employees, customers, community, environment, and so on. The shareholder value theory is emphatically entrenched in today's society and capital markets. However, this hasn't always been the case. From World War II through to 1970, though not defined as such at the time, developed economies globally largely operated according to the stakeholder theory. The idea of corporate and country and company and worker prosperity were closely linked. Beginning in the 1970s, this stance began to shift rapidly towards shareholder value theory. You had the Michael Jensen paper in 1976 and Harvard economist who referenced stock-based compensation as a way of incentivizing management teams. You saw the beginning of stagnating worker pay and escalating executive compensation. In the 1980s, you saw sweeping deregulation from the Reagan administration, the rise of financial engineering, and the decline of union powers. Corporate philosophy shifted from retain and reinvest to downsize and distribute. These trends further compounded through the 90s and into the 2000s. A great lens to view the shift over time from stakeholder to shareholder theory is the purpose of a corporation statement put out by the U.S. Business Roundtable over the years. The U.S. Business Roundtable is an association of leading CEOs of American companies. The timeline essentially evolves from stakeholder theory in the 90s. In 97, you see they put out a statement defining a corporation solely in the shareholder theory camp. And more recently, in August of 2019, they put out a statement defining the purpose of a corporation, largely catering to all stakeholders this time. Company examples of corporate values in alignment with stakeholder theory would include Costco, whose operating model has remained essentially the same since the company's founding. Johnson & Johnson's corporate mission statement has never changed since their 1943 IPO. Microsoft can't claim its mission statement has never been changed as they didn't have one in their original 1975 IPO document. However, the business has accomplished great things over the previous decades and their CEO is extremely well regarded by employees, the media, and the capital markets. On the other hand, Walmart has never exactly been a leader in employee compensation and they've been known to be extremely tough negotiating with suppliers. IBM's mission statement has been a fascinating evolution from one considering all stakeholders in the early 70s to more recently focusing solely on doubling per-share metrics. And Boeing, as revealed by their 737 MAX fiasco in the Senate investigation, from the outside appear to have no strong corporate values whatsoever.
Just Capital is an organization that measures and ranks companies on the issues that Americans care most about. Their mission is to build an economy that works for all Americans by helping companies build a business model that serves all stakeholders. This 2019 survey shows that what matters most in terms of business behavior is things like fair treatment of the employees, having ethical leaders, and minimizing the impact on the environment. What matters least is generating shareholder returns. This addresses what stakeholder value theory is all about. And even those investors that benefited most from capitalism in the last few decades have realized that the sole focus on shareholders' return over all else needs to change. Ray Dalio, one of the most famous hedge fund managers, has said himself that the system is broken because it's not working for everyone. So have we reached an inflection point? Will we use this moment to deal with inequalities that exist in society? With so much going on this year, including the global pandemic, and the Black Lives Matter protests, many initiatives for social change have come into focus, and accordingly, their progress has been accelerated. Quite often, chaos can be a catalyst for change. Here are some recent corporate actions. Social media companies like Facebook and Twitter have taken actions to flag the posts that violate their policies. Heineken is a great example and is a general representation of what companies are doing. They have canceled bonuses for senior management team and first half of 2020 dividend payouts and redistributed them to keep all of their employees and maintain their benefits. Starbucks will also tie part of its executive compensation to the level of racial diversity in its workforce. So the genie is finally out of the bottle. A lot of these initiatives are now underway, as society knows that something is wrong and we're likely to see further changes from the government, corporations, and investors. We're also seeing this focus on social well-being taking hold in governments. New Zealand, for example, has created a well-being budget that focuses on its citizens' level of happiness, driven by factors like environmental sustainability and social equality. For those happiest countries ranked by the United Nations, the factors that make them happy are closely related to having a good social environment with more freedom and less inequality. Companies will need to focus on all stakeholders. Unilever is a great example of this, but more companies are focusing on all stakeholders each day, offering better care and more opportunities for employees in underrepresented groups and producing more environmentally responsible products to reduce pollution. A sustainable business model helps companies mitigate risk and build resilience.
If we think about a world in a capitalist system where companies evolve from operating solely on a shareholder theory basis and more towards an all-encompassing stakeholder basis, we think there are a few things investors will need to focus on. Investors will need to become more vocal about company sustainability reports if they don't already publish them. Further, linking ESG initiatives with some executive pay. On the flip side, investors have already been rewarding companies with strong ESG initiatives and policies. With the growing size of ESG fund flows, we'd only expect the stakeholder-friendly companies to benefit further, attracting more capital, the vice versa also being true. And lastly, investors will need a better understanding of capital allocation and business risk mitigation as it relates to environmental and social issues. As Cidel clients, you can rest assured that these are all factors we consider as part of our investment process, whether in our sustainable strategies or more broadly throughout other mandates. Ultimately, we think investors need to concern themselves with this shift in operating models from a shareholder to a stakeholder world, as stakeholder model can mitigate risks. If the pandemic has taught us anything, it's the importance of each and every stakeholder group in a company's ability to function, let alone thrive and succeed over time.
Thank you for those informative presentations. I'm Ethel Weiner, a wealth consultant in our Toronto office, and your moderator for this afternoon. I don't know about you, but a few things struck me in those presentations. Our first team talked about disruption in the food industry. Ben said that new technologies would use less water, land, and transportation. And Ryan mentioned that costs could be more affordable in as few as 5 years. That seems like a win-win. And on the corporations, Cam talked about how some major CEOs are starting to recognize this shift to caring more about their customers, their communities, etc. And Julie quoted one of the most famous investors as calling for a change. The trend is certainly widespread. And now let's focus on some other trends that may be widespread with our panel, featuring Arthur Heinma, Chief Investment Officer, Charles Lannon, Head of Equities, and Robert Spafford, Portfolio Manager. Thank you to those of you who were able to send in questions in advance. There were obviously some overlapping themes, so what we've done is we've put them together so that we can cover some major topics that were obviously of interest. If anything that you don't get answered today still sits with you, please feel free to reach out to your Cidel contact at any time, and they'd be happy to have a discussion with you. So one of the things that was very clear among a lot of the questions that we got is that this is an uncertain time, and many people are thinking about the future. Arthur, can we start with you with a question about the key factors and risks that investors should be thinking about at this time, both for the short term and on a longer term horizon?
The incoming administration is going to face a number of challenges, and the biggest is really that growth is likely to remain low for quite some period of time. From the top of the employment to the bottom of the COVID crisis, the U.S. economy dropped to over 10 million jobs. It's since recovered to a loss of only 5 million jobs, but at current rates, that's going to take almost 2 years to get back to levels we were in 2019. So it's going to be a big challenge to recover to where we were in 2019. Second, the central banks have fewer tools to deal with economic weakness. Unless with interest rates as low as they are, there's limited scope for them to drop interest rates even any further. So the response to this economic weakness falls squarely on the shoulders of the government. So for the first half of the term of this next administration, the focus is going to be trying to get the economy back to where it was in 2019. And that means increasing government spending. And it remains to be seen whether or not the governments have the will to increase government spending and indeed keep the government spending at levels that will achieve the recovery that they require. And finally, inflation is likely to be muted as the economy is already operating below potential, and which means that labor will not really see any significant wage increases. For investors, this overall lower growth environment is going to dampen returns. So it's increasingly important to find innovative companies like in the fields of precision biology to allow investors to achieve the returns that they require. Charles, can you let me know what you're thinking about right now?
Sure, thanks, Arthur. So as we've discussed with clients quite frequently in recent months and quarters, the global equity market's very much bifurcated in that in addition to these long-term themes, two of which we've highlighted in the earlier presentations, the COVID-19 pandemic has really led to a split in the economy where companies in some sectors, such as technology, certain retailers that have exposure to working from home, certain consumer stocks that have that same exposure, have really gone from strength to strength and have reported record results. Canadian Tire, for instance, is reporting today, and their results are the best they've ever been. There's other parts of the economy, though, whether it's travel, industrials, some of the stocks that will be affected by the slowdown in the economy, such as financials and energy, where the share prices are quite weak. So one of the big tasks for us is to get a sense of some of these stocks that have really had the wind knocked out of their sails thus far in 2020. What are the better quality ones? Are there some interesting opportunities to add some of these names? But as the economy does start to get a bit back to normal after the COVID-19 pandemic, they could see you can see a bit of a path to getting closer to those 2019 levels of performance. So that's been a big area of focus for our team.
Right. Charles, you mentioned the pandemic there, and I'd like to come back to that in a few moments. But first, going back to something that Arthur said about a change to administration. Over the last couple of weeks and even months, we've been following the US elections. And throughout that process, we've heard a lot about America First policies. Rob, I'm wondering if you can comment a little bit on how the final outcome will impact trade and economies.
I think regardless of the outcome of the US election, one of the rare areas of bipartisan consensus in the US right now is legislation targeting China. Being anti-China today is sort of the equivalent of being anti-Soviet Union in the Cold War. You really just need to look at recent legislation that's been passed in the US, and any legislation that's targeted at China has passed with near unanimous support in Congress. So I would really fully expect the pressure on China trade to continue in the future. There's going to be winners and there's going to be lots of companies that help companies readjust their logistics chains and distribution networks to work in this sort of environment. Our task is really to kind of sort through this mess and find those opportunities. We've been in a deglobalizing world for quite some time now, and the COVID-19 pandemic has simply accelerated that withdrawal from globalization. As governments increasingly recognize that they need to regard public health capacity as a national security imperative. Perfect example of that is that many countries, including Canada, are no longer relying on foreign-produced personal protective equipment or PPE, and have instead chosen to directly fund domestic production. You saw the news story several months ago where the Canadian government directly funded a new plan for 3M to make their N95 masks in Canada rather than relying on production from the US. And if you think about it, globalization was really one of the contributing growth forces in the previous century. It's now turning from a tailwind and into a headwind, and will contribute to the low growth world that Arthur just spoke about.
I was going to say, irrespective of the rising political tensions between China and the West, China does remain and represent an important investment theme and opportunity for Western investors. But the country is very, very difficult to invest in. Just in the last 48 hours, we've seen the largest ever IPO in Shanghai get mothballed because of apparently the company involved, which I won't name, but is obviously in the headlines, has grown too big for the regulators' liking. But nonetheless, China is the second largest economy in the world. If global GDP, rough order of magnitude, is about 85 trillion US. It's going to grow 2 to 3 trillion a year, but of that 2 to 3 trillion, rough order of magnitude, half of that's going to be from China. So the strategy that we've employed for quite some time, that we continue to employ, is to use Western businesses that have legitimate, successful, profitable businesses, usually with some sort of technological or industrial leadership in China. And I'd say most of our healthcare stocks, one of the reasons we own them is because they do have very viable Chinese businesses, and that applies to a couple of our financial services stocks as well. So non-Chinese stocks, but ones that have a good moat and a viable strategy for long-term performance to benefit from the growth of that market.
Great, thank you both. You spoke a bit about this concept of deglobalization, especially as it relates to PPE. And I think that's so interesting, given that PPE has become such an important part of our life. When I get dressed in the morning, I look for my wallet, my keys, and my mask. And that's just one of the changes that we've all experienced over the last several months as a result of COVID. Work from home seems to be more than just a fleeting trend. Charles, can we go back to you talking a little bit more about how the changes that we've all faced as a result of this pandemic have implications for the market?
Yeah, so I'd probably just circle back to my earlier comment in that there are probably some longer lasting changes which will affect technology companies, many technology companies that can benefit from doing things like enabling work from home or remote communication, such as what we're doing today. They've seen the wind at their back. On the flip side, there are parts of the economy that have been adversely affected. Commercial real estate is one, travel is another. And so part of the task for us is to figure out there's potentially, maybe even probably, some good opportunities in some of these names that whose share prices have really taken it on the chin thus far this year, for them to come back over 2020 and 2021 as a vaccine gets more and more likely, and even just as the world learns to live with COVID. The other sort of opportunity I'd call out would be emerging market equities. A couple of our emerging market stocks have done fantastically well this year, but a couple of them are down reasonably substantially. And typically, frequently, in our case, it's not because of company-specific issues. It's just because of market cycles. During episodes of panic, usually the US dollar strengthens considerably, which is what we saw so far this year, especially in the second quarter. And that usually is a pretty severe headwind to emerging market assets in general, both their bonds and their equities. So that too is an area of focus for us where we see a host of opportunities with some pretty good runways and flight paths for good capital appreciation over the next 3 to 4 years. The challenge, of course, is whether or not the timing is perfect right now to allocate, or whether it makes sense to do so perhaps 3, 6, 9 months from now.
And part of that COVID response and the way that we've thought about COVID is looking at government debt. There's been an unprecedented amount of government support, especially in the developed world. Arthur, you gave a great talk earlier in the summer about this topic, and we still had a lot of questions coming in. People are wondering, how are we going to pay for this?
The short answer is we're not going to pay for it. The answer is the economy is actually going to grow around it. And I think the best way to think about this is really look at a couple of historic examples. You look at the debt from the Napoleonic Wars, you can look at debt from World War II. In both instances, the size of the debt grew substantially, and most of the individuals thought they'd never be able to pay it off. And the answer was they didn't pay it off, but the economy continued to grow. And that's why the focus is very much has to be on the debt to GDP ratio rather than the actual nominal amount of debt that's outstanding. And the issue that we're facing in a low growth environment and with the government required to spend is that debt to GDP ratio will continue to increase in the coming years. And then over time, as the economy continues to grow, albeit slowly, we'll see that stabilize and start to come down over time. But the bottom line is that we're not going to pay it off because we're not like a household. Governments don't have to pay it off in 25 or 30 years. If you go back to Napoleonic debt, that was only paid off in 2014, so it took 200 years.
Yeah, the real challenge for governments here is if they can spend this incremental deficit spending wisely, to the extent which they can successfully deploy it into projects and initiatives that actually move the needle on productivity, that move the needle on potential long-term output of the economy. That's going to be enormously and unambiguously positive. I think that the risk to the economy is that too much of the spending just sort of disappears into the atmosphere, and there just isn't enough to show for all the incremental spending, whether it's in terms of recovering employment, better productivity, anything along those lines.
So when you're looking at it after inflation, governments are effectively borrowing at negative rates right now. So there are plenty of projects out there that are going to return some positive real return. And this certainly wasn't the case in the late 1980s, where interest rates were significantly higher, and it would be a challenge to find projects that would make a good investment. It's going to be a little bit easier now, and you can think of a number of them out there that could return significant gains in productivity to the economy over time.
Well, it looks like it's good to be in the government. Can you imagine if our credit cards gave us 200 years to pay off our bills? And now, so we live up to our promise of keeping this program to 1 hour, we're going to get to our last question, which we'll pose to the whole panel. We had obviously a lot of questions and concerns from today's guests about the future and how is this going to play out. So I'm hoping the panel can comment on investing in this low rate environment and how you think about putting portfolios together for clients.
I think the key, the investor faces two sort of interrelated problems. One is the low growth environment we've been talking about, and also low interest rates. So for fixed income investments in particular, 10-year government bonds yield about 0.75%. So after tax and after inflation, that's a negative yield. So that means the purchasing power for investing in bonds erodes each and every year. So if you want to retain that purchasing power, you're going to have to think about different investment alternatives or how you're going to shape your portfolio going forward. And certainly in response to these rates, we've done a number of things. We have our professionally managed bond portfolios, but we've introduced 3 different investment strategies to deal with that. We've increased the number of alternative investments we had, And I think that investors also have to think about making allocations to other areas like for instance, small cap. Small cap is an interesting area that can provide good capital gains, and those capital gains can help augment the low return on bonds. And Rob has been spearheading our small cap effort, and I think he would be a good person to comment on that right now.
Great. Can we turn to Rob?
Great. Thanks, Arthur. As Arthur mentioned, particularly in the early part of of this panel, investors are going to be willing to pay more for companies that have strong, reliable growth, that are able to outgrow the economy, particularly in a low interest rate and low growth environment. And this is certainly something that we've seen in the small cap sector. This group of stocks has outperformed massively in almost every geography around the world since the bottom that we put in the stock markets in March. Many of these companies are the disruptors that were spoken about earlier. Businesses have actually accelerated in this COVID-19 pandemic environment. If interest rates remain at these ultra low levels, I would fully expect the small cap sector to continue to outperform.
Charles, did you want to add any comments?
Sure, Ethel. So broadly speaking, within equities, our philosophy doesn't change, right? We always love cash flow. We like dividends. We like strong balance sheets, the sorts of companies that can not just survive the craziness of a situation like the COVID pandemic, but can actually sort of use these circumstances to invest in and build their businesses for the long term, to extend their advantages. What changes, and what's always changes, is the opportunity set we have in front of us. And broadly speaking, from a geographic standpoint, one of the questions or concerns we frequently get is equities are at a record high, equities are at a record high. But that's only part of the picture. Technology stocks in the United States are at a record high, but European equities, Canadian equities, Asian equities, emerging market equities, both at an index level and then at an individual stock level, at a constituent level, there's good value for money to be found right across the board. And then even within the U.S. equity market, there, as I mentioned earlier, there is a disconnect. Many U.S. stocks are actually still quite affordable. And yes, there are pockets of froth, clearly, especially in some of the faster growth technology names. So for us, a real area of focus remains to not just invest in companies that can benefit from some of these long-term changes we talked about earlier today, but also ones that should be able to snap back reasonably quickly as the world does get back to a more normal state of affairs, and COVID-19 happily becomes more and more of an event in the rearview mirror over time.
In here for a second, many of these alternative asset classes, whether it be high yield bonds or alternative assets or private investments or small cap investments, a lot of them carry higher risk than your traditional equities and bonds. And so, I think it's important to kind of remember to invest in these asset classes in a portfolio context. And I think that's where it's really important for investors to talk to their advisors about their risk tolerances and how much risk they're willing to take in their portfolios. And I think one of the things that Cidel does really well is putting portfolios together for clients.
Thank you for that answer. It's great to see that there are so many solutions for these challenging times. And investors are really looking to have as many tools as they possibly can at their disposal. And that's really where Cidel excels. For our existing clients, you've likely had many conversations with your Cidel contact. And for those of you who are not yet clients, we'd love the opportunity to be able to tell you about what we do. And this concludes our panel for today. Arthur, Charles, Rob, thank you so much. And now back to Henry to finish out our program.
That brings a close to our annual investment event. As I said earlier this afternoon, the ideas in the conversation today are born out of thinking deeply about the future and how to prepare your wealth for what lies ahead. On behalf of everyone at Cidel, I want to thank you for tuning in today, but more importantly, I want to thank you for the trust and confidence you've placed in us, especially in these unusual times. Later today, you'll receive a link to a survey. As always, we want your feedback to understand how we can do things better. And also, in recognition of your attendance today, we'll be making donations to several impactful charities. The link will allow you to select your preference. Stay healthy, stay safe, and we look forward to seeing you again soon.